Not all fair value gaps should be treated the same. You can have 4 bullish fair value gaps on the same chart, and even though every one of them eventually produce a move higher, the way price reacts inside of each fair value gap can tell you a lot about the strength of the algorithm's delivery. So in this lesson, I'm going to be breaking down fair value gaps into 4 categories: type C, type B, type A, and A+. And the closer we get to A+, the stronger the reaction we want to see. Before we grade them, let's quickly review what a fair value gap is. According to ICT concepts, a fair value gap is a 3-candle imbalance created when price displaces aggressively in one direction. In a bullish fair value gap, there's a separation between the high of candle 1 and the low of candle 3. The algorithm delivered price higher so aggressively that an imbalance was left behind. Price may later return into that area to rebalance before continuing on its buy program. And in a bearish fair value gap, we can see the separation between the low of candle 1 and the high of candle 3. An imbalance was left behind. But here's the important part. A fair value gap existing on a chart does not automatically make it a trade. I first want my higher time frame narrative. I want to know my draw on liquidity, and then I want to see how price reacts when the algorithm returns to that fair value gap. Before we grade these fair value gaps, there's one level we need to mark, and that's the consequent encroachment, or 50% midpoint of a fair value gap. The CE may be a very simple way to judge the strength of the price delivery. In a bullish scenario, the less price is able to trade below consequent encroachment, the stronger the bullish reaction appears to be, and vice versa bearish. Let's now grade these fair value gaps. Let's begin with the weakest reaction, type C fair value gap. We have a bullish fair value gap. Price retraces into it and trades completely through the gap, actually closing below the bullish fair value gap. At this point, the original fair value gap has not been respected at all. However, price subsequently reverses and runs higher. So technically, the overall bullish idea eventually worked out, but look at the quality of the reaction within the fair value gap. The algorithm needed to deliver price completely through the imbalance and even close below it before reversing. That's why I grade this a C-type fair value gap. It worked out, but this is not the reaction that I want to see that builds my confidence around the trade. If I see this, I need significantly more confirmation on lower time frames before considering entering along. Now we move up one level to type B fair value gap. And again, scenario is we have a bullish fair value gap. Price retraces into the imbalance and trades through it, but does not close below the fair value gap. Unlike the C type, price completely rebalances and then delivers higher. This is stronger than the C type. The entire imbalance may have been rebalanced, but the algorithm did not need to establish an acceptance below the fair value gap before resuming its buy program. So I grade this as a type B fair value gap. It can absolutely produce a trade, but I still want to see a lower time frame confirmation. So in this one, we can see price does rebalance this entire 15-minute fair value gap, but it does not close outside of it. So that's why I graded this a C type. Sorry, a B type. Now things start to get a little more interesting. A type A fair value gap is when price reacts into a bullish fair value gap and may trade below consequent encroachment during the candle, but when the candle closes, it closes outside of the consequent encroachment or above the consequent encroachment. That distinction is extremely important. Price was allowed to trade deeper into the imbalance, but the algorithm did not want to allow the candle to establish a close below consequent encroachment. Instead, price reclaims consequent encroachment and continues higher. For me, this is a strong bullish reaction. Now I'm seeing exactly the type of price delivery that I want. Price traded lower, but closed outside of the fair value gap. And finally, we have the best case scenario, a plus fair value gap. This is when price reacts into a bullish fair value gap and doesn't even trade below the consequent encroachment. Think about what that means. The algorithm returns to the imbalance to rebalance it, but it only needs the upper half of the fair value gap. Price cannot even penetrate through the midpoint before aggressively continuing higher. That shows me extremely strong bullish price delivery. The algorithm does not require a deep retracement. It touches the area, rebalances what it needs to rebalance, and continues on its buy program. For me, I consider this a A plus fair value gap. So now let's look at the progression. Type C, price trades completely through the bullish fair value gap, closes below it, but eventually reverses and runs higher. Type B, on the other hand, trades through and fills the fair value gap, but does not establish the same bearish close below it, and then it runs higher. Type A, price trades into the fair value gap, may penetrate consequent encroachment, but closes back above it and continues higher. And A plus fair value gap, price trades into the fair value gap but does not even trade below consequent encroachment before returning and continuing higher. Notice what is happening. As we move from C to B to A plus, the algorithm requires progressively less bearish delivery before resuming its buy program. That is what I'm grading. Now, I don't look at this and think every A plus fair value gap is an automatically buy, we get into the market. That's not how I use it. Narrative still comes first. If my higher time frame narrative is bullish and my draw is buy side liquidity, then I want price trading into a bullish higher time frame fair value gap first. Maybe that's a 1 hour, 15 minute, or even a 5 minute. Then I watch the reaction, and the quality of that reaction gives me more information. If I get a A or A plus reaction and the correct higher time frame location, now I become very interested in finding an entry. This is also why I don't start my analysis on a 1 minute chart. The 1 minute chart can create, fair value gaps everywhere. If you are staring at every 1 minute fair value gap without a narrative, you can easily convince yourself that every move is a setup. Instead, I use the higher time frame for direction and location. A 1 hour, a 15 minute, a 5 minute fair value gap gives me an area where I can expect the algorithm may rebalance. Once price reaches that area and gives me the reaction I'm looking for, then I drop down for execution. Let's say my daily narrative is bullish. Buy side liquidity is my objective. Price retraces into a 15-minute bullish fair value gap. I watch to see how it behaves around the fair value gap, consequent encroachment. If I get a strong A or A plus reaction, then I drop to the 1 minute chart. And what I look for, I want to see bullish momentum, shift in market structure with displacement. That displacement most of the times creates a 1 minute fair value gap. I then wait for the algorithm to retrace back into that 1 minute fair value gap to rebalance it, and that becomes my entry model. And remember, everything we just discussed works exactly the same way in reverse with a bearish fair value gap, and we're simply just flipping the logic. The stronger the bearish reaction is when price trades into the fair value gap but cannot penetrate deeply through consequent encroachment before continuing lower. So whether it's a bullish or bearish fair value gap, we're asking the same questions. How much of the imbalance does the algorithm need to rebalance before continuing on its intended delivery? Stop treating every fair value gap like it's the same setup. Learn to grade your reactions, C, B, A, or A+. And always remember, a great fair value gap in the wrong narrative is still the wrong trade. Start with your directional bias, know your draw and liquidity, wait for higher time frame PD arrays and grade the reaction. Then use the lower time frame for precision. The higher the time frame tells me where, the reaction tells me how strong, and the lower time frame tells me when to execute. This is how I trade fair value gaps. I hope you found this insightful. Follow me, TriniFX, for more ICT concepts from my perspective. I'll see you in the next one.